Ever wonder how money actually works? It is not as complicated as you think. We will break down budgeting, investing, and credit. Master these basics to truly build your wealth. Let's get your journey started
Welcome
right
to
now.
this explainer. You know, far too often, finance feels like this shadowy, complicated force that's almost designed to confuse us. But honestly, it's really not. It's simply a game. And like any game, it has hidden rules that you can absolutely master once you actually see them laid out. I am so excited to guide you through this today because we're going to break down exactly how this system works, taking all those complicated concepts and turning them into clear, actionable knowledge. All right, let's look at the agenda, which is basically your masterclass roadmap for today. We'll start with the reality of money, see where your money actually goes, examine the double-edged sword of interest, zoom out to the big economic picture, and finally, unlock some real wealth cheat codes.
So, part 1, the reality of money. Uncovering the illusion. We've got to start with a pretty wild truth about the system. It's something that might completely change how you view your wallet right now. The currency you use every single day isn't actually real in the way you might think it is.
Think about a dollar bill next to, say, a literal stick. There is absolutely no inherent legitimacy that makes a piece of paper better than a piece of wood, right? The only reason a dollar bill can buy you groceries while a stick gets you weird looks is simply because we, as a society, have all agreed that the dollar is worth something. Sure, money makes trading easier, but fundamentally it is just a social construct built entirely on shared belief and trust.
Moving on to Section 2, where your money goes, taxes and matchmakers. Let's go to the second level of the game and see what happens to your cash the moment you actually earn it. Because, let's be real, making money is only step 1. Keeping it is a whole different challenge.
Picture this. You've had a grueling month at work, just slaving away, flipping burgers at McDonald's. You get a notification saying you've been paid $2,000 for your hard work. Woohoo! But then you check your bank app, and you only see $1,456. Invisible forces have swooped in and taken their cut before you even had a chance to spend a dime.
Well, those invisible forces are taxes, which are really just the cost of civilization. Income tax hits the money you make to fund things like roads and schools. Sales tax takes a bite out of the money you spend. Capital gains, that actually taxes the money your investments make while you are literally asleep. Then you've got payroll deductions like Social Security, which is basically forced retirement savings, and Medicare, which helps out with health insurance for older and sick individuals. Filing them can be a total headache where the government makes you guess what you owe, but ultimately, these are the mechanisms that fund a functioning society.
So you take whatever post-tax cash you have left and stash it in a bank. Now, a lot of people picture banks as these giant steel vaults guarded by dragons, just sitting on our cash. Not quite. In reality, banks are basically matchmakers. When you deposit $1,000, the bank relies on fractional reserve banking. They only keep a tiny fraction on hand. They take $900 of your money and immediately lend it to someone who wants to buy, say, a jet ski. They make their money by lending your cash out at a higher interest rate than they pay you. And the whole system works perfectly unless everyone asks for their money back at the exact same time, kind of like what happened in 2008.
All right, Section 3, the double-edged sword, interest and trust. The absolute crucial point in mastering finance is understanding the mechanics of borrowing, where two massive concepts, trust and time, are going to completely dictate your financial success. Let's talk about interest. Think of interest as money's way of charging rent to exist in someone else's hands. There are two types here. Simple interest is just a flat fee, like, hey, here's your fee, thanks for playing. But compound interest? Oh boy, that means your money actually has clones, and those clones also want rent. If you owe a 20% interest rate on a credit card and miss a payment, your interest earns interest, turning a $12 burrito into a $50 regret. But on the flip side, investing at a 7% annual compound interest rate is like a literal cheat code, where your money just duplicates itself until you wake up old, rich, and probably a little smug about it.
But to get those loans in the first place, you are judged by this shadowy algorithm known as your credit score, which ranges from 300 to 850. This 3-digit number isn't about your wealth, it is strictly about trust. Lenders just want to know if you'll actually pay them back. Anything below a 580 means you are a walking red flag to a bank. But if you're over 750, you are just sparkling with adult credibility.
And here's exactly how they calculate that score. Payment history is the massive one. Do you pay on time? Then there's credit utilization, which is just how much credit you're using versus what you actually have available. They also look at your credit age, your mix of loans, and any new credit applications. Honestly, your credit score is like a pet dog. Ignore it and it poops all over your life, handing you soul-crushing 27% interest rates. But feed it with on-time payments, and someday it helps you buy a house. You could have zero debt and still have a trash score if you have no history. It's all about looking good to lenders.
Let's zoom out to Section 4, the big picture, invisible economic forces. We've talked a lot about your wallet, but what about the massive, invisible economic forces outside of it that dictate the value of every single dollar you own?
If you've ever bought a bag of chips that felt 30% more expensive and somehow half-eaten, you've met inflation. It's the slow, quiet erosion of your money's value. Think about it like this. If 1,000 people want a $500 TV, the price stays $500. But if suddenly 2,000 people have cash and want that exact same TV, the business is going to raise the price to $800. That's inflation. Too much money chasing too few goods. It can also happen from supply chain hiccups or even just people assuming prices will rise. A predictable 2% inflation is totally fine, but when it spikes, your savings just die.
Now, to fight that inflation, the government steps in and raises interest rates to make borrowing pricier. That cools off the spending frenzy, but it can sometimes trigger a recession. This is when the economy actually shrinks for at least 2 quarters or 6 months. In a recession, jobs vanish, companies cut their costs, and people just stop buying things they don't absolutely need.
I absolutely love this quote because it nails the vibe perfectly. Think of the economic cycle like a booming house party. In the boom phase, everyone's dancing, everyone's spending. But eventually reality hits. The lights flicker, someone checks their bank account, and suddenly the DJ's playing sad lo-fi beats about corporate downsizing. It is painful, for sure. But remember, recessions are just temporary resets. Eventually the government lowers rates, businesses rebuild, and the growth resumes.
Which brings us to our final and definitely most exciting part, Section 5, the wealth cheat codes. Winning the game. Let's talk about how to actually fight back against inflation and rig this game in your favor.
Your primary weapon here? Investing. Investing means trading your money for more money rather than just trading your time for a paycheck. Let's run through the main vehicles. Stocks are just tiny ownership slices of companies. Bonds are basically you loaning money to an entity in exchange for interest. Funds are collections of stocks and bonds that save you from having to play financial games one by one. And real estate is property you buy hoping someone else pays to live in it. Yes, markets go up and down, but the real danger isn't the risk of the market dropping, it's never investing at all and letting inflation quietly steal your future. But to really succeed, you've got to understand value. Picture an average gray rock. Totally worthless, right? Now picture a shiny yellow rock, gold. Incredibly valuable. Why? Gold isn't inherently worth more than a regular rock. It's simply rarer, and human perception gives it a higher value. This brilliantly illustrates how the whole world works. It's the exact same reason Steve Jobs made billions creating the iPhone, and it's why Gucci can charge 100 times more for a handbag than Target does. If you can figure out how to provide or create value, you will earn a lot of money.
But the ultimate cheat code, the absolute greatest force in wealth building, is time. Not luck, not a massive salary, just time. Most wealthy people didn't hit the jackpot. They just gave compound growth 30 years to do its thing. Money sitting quietly in an investment multiplies slowly at first, and then much, much faster. This is exactly how ordinary people with completely average paychecks can retire with 7 figures. They didn't somehow beat the system, they just used the system consistently over decades.
As we wrap up this explainer, we've decoded the basic rules of the game today. You've seen how taxes, banks, and inflation are constantly pulling at your cash, and how investments and compound interest can actually build your wealth. So I'll leave you with this to think about. Will interest be the slow burn that causes financial fires in your life, or will it be your absolute best unpaid employee duplicating your wealth? The rules of the game are laid out, but how you play it is entirely up to you.